Hello everyone, it's Red with RedDragonLeo.com. It is January 2nd, 2014. Happy New Year, everyone. Thought it was time to do an update, let you know what I thought, what I think is going to happen this year. We have a nice move down this morning, 10 points on the SPX, as you can see here. And I think what we're entering right now is some type of wave 4 down, a short wave. I don't think it's going to last too many days, 1 day, even 2 days. And then I think we're actually going to turn and go back up. After this comes down to some level, I don't know what level it's going to come down to. And this may be all we get out of it. Maybe 1830 or something is the bottom. I really don't know. It might last more than one day, though. You go down here and you look at the MACDs and the histogram bars. You can see they are going down and getting ready to dip negative. But keep in mind that there is no negative divergence yet. So that means you need to either dip negative and turn and come back up and put in a lower high. And I'm going to use my little pen here and draw that for you. So, let's see here. So basically, what I'm kind of looking for here is one or two scenarios here. Basically, you're going to, where are we at here? Come on, baby. Come on, work. So either we dip negative for a few days. Come on. And maybe 3 or 4 days, and then come back up and put in higher. I must have a lot of stuff running on my computer, so I do apologize. Higher bars here, and that puts in a negative divergence. As you could draw a line here. Well, if this stupid computer one runs too slow. Let me pause some things on the computer, see if I can't get it to run a little faster. So I'll come back and redraw that. So hang on. Okay, now let's see if this runs any better. Shut down one of my windows. Okay, so back at it here again. Come on, baby. Well, maybe it's the battery in this little pen handheld tool. So some way or another, it's going to maybe dip negative for a few days, and then come back up here and go positive to put in your negative divergence. And yeah, that's a horrible line, but you get the idea. And then, of course, God dog it, man, this sucks. Then, of course, crap. Come on, man. Got to be the battery, I guess, in this stupid thing. I really don't know. But it's irritating the crap out of me. So we're just going to skip that and move on. So I'll use my mouse here so you can just look at it with my mouse, since this thing is not wanting to work too good today. So if we go down today and maybe a little bit tomorrow, maybe tomorrow is Friday, I'd expect a little bit of a bounce tomorrow. Then maybe back down again a little bit next week, maybe Monday, Tuesday, or something like that. I don't know how many days they're going to go down, but I will say this. If you remember stuff that the guys at Mr. Top Step talk about, they say the Thursday or Friday prior to options expiration week is the typical time that they put in the low for that period, and then they run it up during options expiration week so that they can squeeze out all the shorts, so they don't got to pay them out. Now this is something that those guys stated that they learned from a guy named the Pitbull, which I guess is somebody that's been around for a long time, 20, 30 years on the floor. So if we are to say go down today, and then maybe Friday you go up a little bit because it is the first of the year, you turn and go back up a little bit, maybe put in a little lower high. And then Monday you're kind of flat a little bit. Then maybe down on Tuesday, down on Wednesday, down on Thursday. You put your low in there, and then you run back up Friday, all the way into the 17th, and to make that close out higher. Now, that doesn't mean it's going to turn at that date. It might not turn until Monday or Tuesday of the next day of the next week. So what I would think is that you could possibly go from, let's see if I can't draw a trend line here, from maybe this line to this line. It is possible. That's a possibility there, that you could go down to about 1800. You very well could. You know, there's a lot of support there at 1810, so you might hit that, and you might turn back up. But at some point this is going to end, and then you're going to go back up again one more time. I think that this is only some type of wave 4 down with one more wave 5 up. I am still looking for about 1940 area, plus or minus 20 points, so maybe 1920, maybe 1960. And that on the Dow would be approximately 17,000 plus or minus 100 points. That's what I'm looking for. So as this histogram, these bars, this tower goes down, you can either turn and go back up and make and not even go negative, and that would mean we're done today essentially, and you start putting in that higher or lower high for the next hump, you know, like 2 camel humps there. You can either do that, or it could actually dip negative for a few days. You know, maybe similar to, you know, this period here, where it dipped negative for a few days, then it come back up, and obviously put in a lower high there, a much lower high, and that would have been major negative divergence. And who knows what it'll look like? I don't know. With it being light volume, first of the year, it might look like that, or it might have some more humps, maybe like back over here in March or April. You know, we're basically, you can pretend like March is the hump that we've got right now, right here, and then you dip down for a few days, you come back up into April. But see, that area just chopped sideways. I am looking for more upside. So the important things that I want you to focus on is that Bernanke speaks on the 8th. That's it's a rehash of what he said in December. So that is, let's see, I pulled that up on my, let me see here. Let me pull this up here for you folks. But this is very important. You know that the market turns a lot around Bernanke speaking, and we know that they have pulled out $10 billion out of the market. Okay? So, that's the wrong link. They pulled out $10 billion out of the market, and we're now down to, here we go. We're now down to from 85 billion to 75 billion into the market. So here's your things of note. The January 8th, right here, this is important. They are rereading the FOMC minutes from the meeting of December 17th or 18th. But traders still kind of look at that like maybe Bernanke might say something new. So and that just happens to be the Wednesday. So you could have a low on Wednesday or Thursday. You know, traders sell off a little bit this week. You know, today, maybe up a little bit tomorrow, like I said, just because it's Friday. And then down these days here and end right here on Bernanke speaking, and that would be the low for this week. And then you rally into next week, into that options expiration week, which is always the 3rd Friday of the month. Now, I don't know how well this theory is being affected by the weekly options that come out on the 3rd, the 10th, the 24th, and the 31st. But you got to remember, these monthly options, you could have bought them a year and a half ago. So they've got a lot of interest in them and a lot of different positions. So the market makers have to move the market around in order to steal the sheep's money, because they don't want to pay nobody. So in order to steal your money, they have to scare you a little bit the week before that, take it down a little bit, then run it up that week. Doesn't always go up on that week, but I'd venture to say 80 to 90% of the time we see a bullish options expiration week. So with that theory in mind, timing it out around January the 8th, somewhere in that area, or January 9th or 10th, you see the end of this move down. Then I would expect it to turn and go back up and head towards that 1940 area. Now, when will it top into that area? Well, the next important meeting here, which I find it strange that they've got two of them here in 1 month here like this, but the 28th and the 29th, a 2-day meeting. I can tell you that the 29th of the month many times is a bearish period. It may have to do with the fact that 2 plus 9 equals 11. It's an 11 date. So it might be that, but obviously that would be too obvious. But I think more than anything, it is a period that is commonly after, a week after. In this case, the 29th is here and the 17th is there. But in many cases, it's just 1 week after the third Friday of the month. We just happen to have 5 Fridays in January. But many times there's 4 Fridays, and the 29th is within 5 or 6 days or 7 days of that Friday. And so what they do is they put in the top there on the 17th to squeeze out all the options, the put options, to steal their money. And then they don't do much on Monday, and then a little continuation pop maybe on Tuesday, and then they start trailing down, and then they just generally have a nice down day on the 29th. Well, my thoughts are that we'll probably go into the 17th in the high area, maybe 20th, 21st, maybe even the 22nd. Yeah, maybe even the 22nd. Okay, so if you did that and you topped in that area, maybe on the 22nd, at that point, the traders would probably say, hey, Bernanke's speaking again on the 28th and the 29th. This is a new meeting. We need to hear more information about the coming quantitative easing that they're pulling out of the market, the mortgage buyback programs that they're doing. So maybe we should close in or close out our longs and let the market drift down a little bit. And that's kind of what I'm thinking will happen. So I think we'll probably, in this 21st, 22nd, I think that's when we're going to hit our final high. I'm just guessing at this, but I'm estimating somewhere around 17,000 on the Dow, again, and around 1940 area on the plus or minus 20 points on the SPX. And then I would expect traders to start to sell off a little bit into Bernanke, not knowing what he's going to say. Then when he comes in here and whatever he says, I don't know how this is going to play out. If he says something negative, the market's just going to start tanking from there. But if he says something a little bit positive or nothing major, then you could see a wave back up right after that. So if you see the wave back up, well, then maybe you've come down here to this 1800 area, 1810, and then you're starting up here to maybe 1920, 1940. Then you come back down, and then you go back up again. Now, whatever he says, we also have to worry about the more important thing here, and that is in February the 7th, according to the video that is on the blog right now in the comment section by Jim Sinclair. He says that about 2.5 minutes to 3 minutes into that video, it's like 40-some minute video, but you can just watch it 2.5 minutes to 3 minutes. He mentions that well, let me just show it here. Looks like let's see. Yep, I need to reload the page. Sometimes I have. Okay, it's this video. I'm going to reload that so you can just see what it looks like. But basically, he states that the 7th is an important date that they have to make a decision on, I guess, raising the debt ceiling again or not raising the debt ceiling. So, let's see. Okay, so I put a little comment here so for you to read. Between 2:30 and 3 minutes in, he talks about February 7, 2014, the next date for the go-around on the debt problem. Now, that date is, of course, dead set in the middle of the Legatus meeting. Now, you guys know I did a past post on Legatus and turns in the market with Legatus. and I estimated about 70% of the time it turned on that on those dates. And here you have February 6th through the 8th, 2014 is the next Legatus meeting. And it's in my neck of the woods down here in Orlando, about a 2 to 3 hour drive from me, or 2 hour drive, I think, because I'm in Jacksonville. So, anyway, that would be my suspected time that you're going to have something significant happen. So if we are to rally back into that period, if you hear lots of positive comments about the market and everybody's like, yeah, no worries, we raised the debt ceiling back in 2012, back in November, when the market was at 1343 at bottom there, and they raised the debt ceiling then. And then recently, last year in October, when we thought the market was going to sell off, they came out of that Legatus meeting and decided to raise it, which, by the way, was right here. The 10th through the 9th was that Legatus meeting. I'm sorry, the actual meeting was, you actually look here, the meeting was the October 8th through 17th. Okay, well, 8th through 17th, and the market bottomed on the 9th. So it did make a turn. It made a turn up. Now, we thought it was going to crash and turn down. I didn't say crash, but I thought it was going to be a nasty move down. And you could call it a crash, I guess. But I guess the decision that they made at that point, you don't know the date that they're going to do it, because the 8th through the, obviously the 8th through the 17th was a big time period, 9 days. But they had those meetings, and you typically see the market turn somewhere during that meeting, usually in the middle of the meeting or a day after. So that happened to be a 9-day meeting, and they bottomed it on the 9th, and they turned it and went back up. So this go around, I think what we're going to see is a turn either on the 28th or 29th when Bernanke speaks, which probably is not going to be the big turn. More likely, I think it's going to be the 6th through the 8th there. And I've noticed with those particular meetings that when they're short 3 days, it doesn't always happen right in the middle of them. You know, could very well happen the next Monday or Tuesday. Say the next, the next Tuesday is an 11 day. You know, it's a daily 11. So you know they do use these rituals. So you got to keep that in mind. It could happen on the 7th, though. You know, we will keep that in mind as well. You don't know. So it could happen on the 6th, 7th. Well, not obviously the 8th, the 10th, 11th, somewhere in that time period. I'm expecting the market to have made the high at the 1940 area, either on the 28th, 29th, already made the high and dipped down and then back up, or it's putting in its final high on this period. So I don't know which one's going to happen. So that is the date that I am looking for this final high. Then at that point, I'm looking for a very, very nasty move down in the market. And I think we are going to go revisit the opening high back here from 2013 on January the 2nd, just like it is today, January 2nd, but I'm talking about a year ago to the date 2013. That area is 1426 to 1462. I think we're going to end up revisiting that area this year. And I'm not saying that's going to happen all in February or March. So, you know, obviously there'll be waves down, but I think that's going to be the final low for this year. And then we rally from there. If I had to go for time period, I would think that it would happen around mid-July is when I would think we're finally going to bottom. Makes the most sense, and then you turn and go back up into August, and everybody's bearish in August, thinking it's going to crash, and no, you just have a tremendous rally in August and squeeze out all the bears that you put your bottom in for the year, somewhere in this area here, around from that area, 1420 to 1460 area, and then you rally. So how fast that goes down, I do not know, folks, but that is a nasty move down. So I would just be looking out for the zones I just spoke of, 17,000 plus or minus 100, 1940 plus or minus 20, and look for the dates, 28th, 29th of this month with Bernanke, and 6, 7, 8 for February. Those are my key dates that I'm looking for. That is it. Happy New Year, guys, and do come by the blog occasionally and post. I know I'm not doing that many updates, but I'm still around on the comments section, so do comment. I will answer it as soon as I see you commenting. Thanks a lot, and again, Happy New Year to everyone.